Stock. A small part of a company you can buy. If the company does well, your stock can go up in value. If the company does badly, your stock can go down. It's a simple way for people to own a piece of a business. IPO. A company sells its shares to people for the very first time. Before this, only the company's owners had them. After an IPO, anyone can buy a small piece of the company in the stock market and become part owner. It's like the company opening its doors to everyone. Stock exchange. A place where people buy and sell shares of companies. It works like a safe market that brings together buyers and sellers. Instead of trading in the street, the exchange makes sure everything is fair, organized, and easy for everyone who wants to trade stocks. Broker. A helper who lets you buy and sell stocks. You can't go straight to the stock exchange yourself, so the broker does it for you. Today, most brokers are apps or websites on your phone that make trading simple and easy for anyone. Market order. When you buy or sell a stock immediately at the current price, you don't wait or set a special price. It's the quickest way to trade because the order happens right away at whatever price the stock is being sold for at that time. Limit order. When you choose the price you want to buy or sell a stock, the trade will only happen if the stock reaches that price. It gives you control, but it may not happen right away, or sometimes may not happen at all if the price isn't met. Liquidity. How easy it is to buy or sell a stock. If many people are trading it, you can sell or buy quickly. That's high liquidity. If very few people trade it, it can be harder and slower to sell or buy. That's low liquidity. Stop loss order. When you tell the system to sell your stock if the price falls to a level you choose, it helps protect you from losing too much money. Once the price hits that level, the stock is sold automatically, even if you are not watching. Bull market. When stock prices keep rising for a long time, people feel confident, buy more, and believe prices will go even higher. Bear market. When stock prices keep falling for a long time, people feel negative, sell more, and believe prices may drop even further. Volatility. How much and how fast stock prices move up and down. If prices change a lot in a short time, it's high volatility. If prices stay steady without big changes, it's low volatility. High volatility can bring big profits, but also bigger risks and losses. Risk tolerance. How much risk you are comfortable taking with your money. Some people are okay with big ups and downs for higher rewards, while others prefer safer choices with smaller gains. Knowing your risk tolerance helps you pick the right investments for you. Market capitalization. The total value of a company in the stock market. It is found by multiplying the stock price by the number of shares a company has. Bigger market cap means bigger company. Investors use it to see if a company is small, medium, or large in size. Dividend. Money a company gives to its shareholders as a reward for owning its stock. It usually comes from the company's profit. Some companies pay dividends often, like every few months, while others don't pay at all and keep the money to grow the business instead. Price to earnings ratio. How much people pay for a stock compared to how much money the company earns. A high PE means the stock costs more. A low PE means the stock is cheaper. EPS, earnings per share. It shows how much profit a company makes for each share of its stock. The higher the EPS, the more money the company is earning for its shareholders. Investors use EPS to see if a company is doing well and making steady profits. Portfolio, the collection of all your investments, like stocks, bonds, or funds that you own. It shows where your money is placed. A good portfolio usually has different types of investments to balance risk and reward instead of putting all money in one place. Diversification. It means spreading your money across different investments instead of putting it all in one place. This way, if one investment loses value, others may still do well. It helps lower risk and makes your portfolio safer and more balanced over time. Index. A group of selected stocks that shows how the overall market or a part of it is doing. For example, the S&P 500 shows the performance of 500 big U.S. companies. If the index goes up, it means most of those stocks are doing well, and if it goes down, they are not. ETF, Exchange Traded Fund. It is like a basket that holds many different stocks or investments together. When you buy one ETF, you own small parts of all those stocks at once. It's an easy way to invest in many companies without buying each one separately, and you can trade it like a normal stock. Okay, if you want to know all the smart ways to invest your first $1,000, check out my next video. I'll walk you through every option. Click over and I'll see you there.